Okay, Jeff, if you had $1 million portfolio, how are you allocating this today?
I'm putting all of it in Bitcoin. No, I'm just kidding. That would be a bad idea. If you had $1 million today, I think that the number one strategy investors should pursue is to barbell it. And so what I mean by that is instead of approaching it the traditional 60-40 where people are allocating between fixed income equities, it's time to think outside the box and think of all the different ways that you want to take bets on fat tail idiosyncratic events. And so Bitcoin is one of them, but I think there are a lot of other domains for which investors can find expertise in. One angle in particular that I think is really exciting is prediction markets. You may have seen that Polymarket is now becoming compliant here in the United States, which means that you and I and any retail investors on earth could actually start investing in events. And events are outcomes in which I believe every individual investor has proprietary advantages depending on their knowledge. So I think that's an interesting corner of investing that we just haven't imagined yet as to what an active investor could look like versus a passive investor.
What allocation goes to prediction markets and betting markets?
Yeah, so you can bet on cultural events, but you can of course bet on economic events with a lot more precision. So there was a market, for example, on what names would come in or out of the S&P 500 reconstitution event. And historically, what you might have done is you buy the stock that you think is going to go in the index. But of course, there's basis risk as to whether that stock then actually goes up. And that basis risk is actually polluting to the thesis that you may have. So now, if you want, you can actually bet on the stock that you think will get into the index, and it's a clean-cut, black and white digital bet. And so those things, I think, give you a lot more surgical precision for any individual investor.
Okay, Jeff, if we're looking back 50 years from now, what do you think investors are getting wrong today?
I think that we are so used to thinking about the risk-free rate in a very particular definition, which is the ability for the US debt to pay back its sovereign debt, hence the risk-free rate being whatever the 10-year, 30-year rates are. I think that in the next 30 years, people are going to rediscover what risk-free in itself inherently meant. And I always joke that, the S&P 500, S&P ratings agency is not completely correct when they think about upgrades and downgrades of sovereign debt because they don't include the power of the military as a component of how creditworthiness a sovereign could be. And in that context, I think all of us need to think about what risk-free means today to live in this world.
Wow. All right, Jeff, thank you so much.
Thanks for having me.